This is, thank God, it's Friday. However, it really hasn't turned out to be a very great week with respect to the way the markets have panned out. But the real questions are, what do we do with these markets, with the valuations, with the kind of correction that we are looking at in this particular week? But for that, we are in conversation once again with Hirren. He's the Chief Investment Officer at Alchemy Capital. Hirren, thank you for joining us once again.
Pleasure to be here.
The last time we spoke to you was back in October. This was before demonetization, before GST. So a lot has passed through. But let's start off with the most immediate concern, and that is the correction that we are looking at. Is this the market's alibi, our global events, the Indian market's alibi for a long-awaited correction?
I think so. I mean, that's usually happens that you have had a very strong rally in the last few months. Probably it surprised people on the upside. And at some point in time, bull markets also go into correction, and they always look for some alibis to say that, oh, it's the geopolitics or North Korea, or, it's the India, China. But these are all typically just alibis for a normal correction to set in. And I think that's what's playing out classically in our markets right now.
Right. So if you're suggesting that it's largely because of global events, do you see any concerns, any underlying problems with the economy, or for that matter, any other domestic reasons behind this correction?
So, I think that as we all know that this market has been searching for earnings growth for a long period of time. And that has gotten delayed and delayed for something or the other. To be fair, I think earnings were likely on an uptick Q2 last year. But because of demonetization and then subsequently now the GST, I think the things have got deferred. Right. So hopefully, I think that the big disruptions are out of the way. And, hopefully, finally now earnings will catch up in the second half of the year, provided there are no major geopolitical events or disruptions. So I think the big concern is that we are in a classic PE expansion cycle in the market. And typically this happens when you are coming off a low, right? And, we've seen no earnings growth in the last 3-4 years, but the markets have gone up. And partly you can explain the PE expansion by the fact that interest rates have fallen dramatically, so your cost of capital has fallen, and that means that PEs could expand. And I think a part of the PE expansion story is basically because markets typically anticipate a recovery 12 or 9 months ahead of the actual recovery. Right? But until earnings actually come through, markets are always going to be susceptible to the kind of corrections that we are seeing in the intermediate, right? So I think that's what's really going to happen. So I think what the market is really looking for is a much more broad-based earnings growth recovery, not just limited to a few companies, which has been the case for a long period of time.
So Hiren, what kind of correction do you believe would offer an opportunity to make fresh investments? And what should a retail investor do right now? Should he just book out partially and add more later? Should he hold or add more? What would you advise a retail investor to do at this point?
I think for retail investors, clearly we are at valuation levels where they need to take a 3 to 5 year view, right? I don't think from a very secular perspective, these are times to book profits. I think we are in the early stages of what I believe is a multi-year bull market. In my sense, we are like in mid-2004 of the 2002 to 2008 bull market cycle, right? So it's not 2002, so we are not cheap. We were that cheap in 2013, but that's when the macro was the worst. So typically what happens is that you have a very worst macro, there is a massive risk off, and that's when the markets are at the bottom. And then when things improve, the P's expand. And then the earnings catch on. And then you have a virtuous cycle of earnings coming in, P's correcting, again earnings growing, again P's correcting. I think we are still at the early stages of that bull market cycle. And hopefully this is not the time to take money off the table. So unless we see 2, 3, 4 years of solid compounding earnings growth,
right,
and then on top of that you see high Ps, that is the time then we should think about taking money off the table, not too early. This is too early. In fact, currently you should look at every correction to look at adding. Now whether the correction is just a shallow 2-3% or whether it's a deeper 5-7% correction, it's anybody's guess.
right.
But I think people should use corrections to add. I don't think we are at a stage where we should thinking about booking profits if you're a long-term investor.
All right, continuing with the domestic macros, Hiren, so far consumption has been in a sweet spot and that has been actually driving economic growth so far. The worry now is that economic growth is not creating enough jobs. If that is the case, what does it mean for consumption and hence for consumption-related investment plays then?
No, that's true. I think there is a worry that private investment is not picking up, right? I think that the engine of our economy is basically firing on just 2 engines out of the 4, right? So typically you have private consumption, you have public investments, you have private investments, and you have exports, right? So it's the classical C plus I plus G, and then it's the export minus imports, right? So that's how you get your classical economic equation. So I think out of all the 4 engines, right now the only 2 engines that are firing are that government spending and personal consumption or private consumption. Exports, though, has recovered from the absolute lows. There are still challenges because global growth is not as great, and now we have headwinds of a currency, and there are certain large exporting sectors in India which are going through their own phases of difficulty, like the tech sector and the pharma sector, right? So so you're left with 2 engines. I think what's going to happen is that I think one more engine will probably kick off, and which is FDI. Right. I think that increasingly we are seeing that the multinational corporations are getting excited about investing in India. And given the fact that in the recent past this government has won several state elections, many of these long-term FDI investors are thinking that this government will now have a much longer runway. So I think that you will start seeing FDI coming in. It's already been very strong. So I think that's going to be the 3rd engine. I also believe that probably 6-9 months down the line, as GST gets streamlined, I think government tax revenues will surprise on the upside.
Right.
And they're going to probably use that additional tax revenue to pump the economy. One is that they're going to spend that on infrastructure, and second, it will be funneled through the direct benefit transfer to the bottom of the pyramid. So your kerosene subsidy and your LPG subsidy, your fertilizer subsidy. So people are going to use the buoyancy in the revenue. The government is going to use the buoyancy in the revenue to then pump that money into the economy. So I think that that is what is likely to drive. So when you're basically recovering from the bottom, it is never broad-based, it's always narrow.
Right.
But then you have a chain effect. So if government starts spending on infrastructure, then the infrastructure guy needs to hire a bulldozer, or he buys more cement, he buys more steel. You need to transport all of that, so suddenly demand for trucks goes up, and that's how the whole cycle starts growing. But I agree with you. I think if there is one challenge that this government has got, which it'll have to tackle, is job creation.
All right, so there are, in the past there have been instances when you see the markets move up, your price to earnings ratios expand, and eventually after maybe with a lag you see earnings recover.
Yes.
I'm assuming that we are in that sort of a phase right now, which means that we are expecting earnings recovery to come over the next few quarters. But while this recovery comes, if we were to take a short-term, point of view, do you expect the markets to consolidate over the span of next 1.5 years? Or will there be a lot of underlying churn in between, but when it comes to benchmarks, that could remain at these levels?
See, I think, so there are two things. One is the near term and one is the more medium term, right? My own assessment of market cycles is that the first phase or the first leg is always like climbing the wall of worry, right? Which is typically what is happening right now. I think that if the next 2-3 quarters, earnings should look strong because the base is lower, because you'll now be hitting the quarters where there was demonetization for, you know, the third and the fourth quarter, and then subsequently the GST quarter. So if you have back-to-back 2 to 3 quarters of strong earnings growth on a YOY and a Q-on-Q basis, then the market will take support of those earnings and could climb higher. Now, usually what happens is that typically in the early stages, because businesses are not doing well, all the liquidity, and especially in our case, we've had extra liquidity come in because of demonetization. That liquidity is not being used in businesses because the businesses have not yet taken off. So that liquidity typically goes and chases returns in assets.
Right.
This time around, it's not the hard assets, it's equities, because fixed income returns are low and nobody wants to buy real estate and gold, right? So all that liquidity is chasing returns. Therefore, when the actual numbers start to improve from an economy perspective, so let's say your IIP starts growing, your GDP starts growing, your credit growth starts to reflect that, the markets would have already discounted it.
Right.
And it's that point of time that the market goes into some kind of a correction and consolidation phase.
Right.
And every time before all, see, the beauty about the markets is that, you know, when everything is visible, it's already discounted, right? So right now earnings are not visible and people are saying that, oh, it's all liquidity driven, but it's always liquidity driven. You need money to buy stocks. You can't, you know, get higher levels out of thin air, right? So my sense is that if the next 2-3 quarters, which is not too far away, if they can show good YOY and Q-on-Q numbers, then there will be legs to this market even further.
Right.
And probably sometime next year, when, you know, the earnings actually start to show and you know, some of the lagging indicators start to show that,
right,
that's when the markets actually go into a correction and consolidation phase.
Okay.
Now, you know, how this will pan out is anybody's guess, but this is how typically a market cycle works.
Right.
To me, it looks like copybook style right now.
But I do want to address the risks for earning recovery. Now, we have a low base. We have GST, all the challenges that have already played out, and we're expecting implementation eventually to boost earnings going forward. We also have improving macros. That is an assumption that we're making. So what are the risks that can pose when it comes to earnings specifically over the next 1.5 years?
See, I think that, so what we have been seeing is that volume growth is not there in the economy, right? And, you know, partly some of these resets that have happened, whether it is demon, whether it is GST, is impacting a certain category of businesses and consumers, right? Consumption and growth is also about confidence, how confident you feel about things, right? So I think that if the feel-good factor doesn't come back, right? If you're constantly battling a completely new paradigm in your life, like suddenly you said you don't have access to cash.
Right.
So your mindset is not about going on a holiday or spending your money. You're battling something. Now suddenly there is GST, you know, so you are trying to adapt to a new business environment.
Right.
But after a period of time, you need a period of stability where there is visibility. The consumer needs visibility, the producer needs visibility. So I think a lot of that is likely to be more qualitative, you know. So if people feel confident and if there are not too many variations going forward from government policy perspective, or from any international global events. So I think that if now the government just focuses on implementing what it has already done and does not bring in one more major disruption,
Right.
and people can get on with their lives,
Right. Yeah.
and there is no major global event which again takes people's minds off or creates a risk of sentiment, then you are setting the base for a good earnings recovery. Otherwise, those are the things which are a risk. So if tomorrow they come up and say, you know what, now I'm going to change this, and that's another big disruption, then you may have a situation where the earnings growth get delayed even further. And then there is something about a momentum in an economy, right? So you have, you were just starting the car and you apply the brakes, and if you lose momentum, then to start the economy again is not easy. It's not a switch on, switch off.
Right. Yes.
So I hope that now that we start utilizing the benefits of these big reforms that we have done, and that money flow starts, and that starts to create demand and confidence both for industry as well as for consumers. If that happens, I think you will see an earnings growth coming in. If that doesn't happen, then you have a problem.
Okay, Hiren, you have said, you have advised that we should probably look to add if we continue to see any sort of a correction. But then, even at the current valuations, where does the retail investor really put money? Where do you still see value? Which are the areas which you still like, even at these levels?
I think for retail investors, I think the trend that has been, doing well, which is put in money systematically, put money in, diversified mutual funds, so that you get exposure to a broad sectors of the economy. And there are several good, mutual funds which have a very good long-term track record. If you're a very savvy investor, then you could come to a portfolio manager like us, where we create a more compact portfolio of high conviction ideas for the long term. Where do we see opportunities? I think I think the way we are looking at the markets right now is that there are certain secular themes which everybody likes. So those are your private banks and your NBFCs and your auto companies and a few select high quality companies which have continued to compound on the consumer side, right? So every long-term portfolio will have some exposure to these sectors. But at the same time, you should now start looking at, I would say, companies where the balance sheets are good, but where the revenue traction was not there until now. And you believe that with some of these reforms and growth coming back, the revenue traction will also start to come in. And those are not yet reflected in their valuations. And there are several like that, and I'm not talking about very leveraged companies or companies which had broken business models. Even very good companies, there are several of them which haven't done as great in the stock market over the last 2-3 years because the rally has really been concentrated in a handful of companies, right? So you start building your positions in some of those companies where, as I call it, the bucket where the balance sheet is good, but the P&L was still struggling. And you believe that the P&L will start to grow. And once that growth comes in, there is operating leverage and the market recognizes it, and then you start getting the benefits of valuation. So you will have to play a little bit, I wouldn't say contrarian for the sake of being contrarian, but you have to start looking at domestic oriented sectors where you think that the growth in infrastructure or the growth in volume growth will grow these companies. And then there are at least 2-3 large sectors which are going through a very tough problem. You will find opportunities over the next 3 to 6 months to be a contrarian there. Right. So, pharma stocks have corrected almost 50% from the peak. IT hasn't been doing well. So, it's not that this is going to be the situation for the next 3 years or 5 years. This is a temporary blip. It might still continue for a couple of more quarters. but it will also give you an opportunity to buy into some of these names. So I think you take a lot of this and combine it into a portfolio, and you still have a lot of opportunities to make money. The problem is that because so far the visibility has been restricted to very few companies, that's where all the money is chasing those names, and those valuations have become expensive in the marketplace.
Hiren, we know about your love for Bajaj Finance. You have spoken about it in the past. But there have been some concerns which have been raised by a certain section of analysts, where they're saying that there are increasing worries as far as the asset quality is concerned due to the increasing share of unsecured lending when it comes to some of these consumer-oriented NBFCs. Do you still believe the kind of growth momentum, the current valuations and the asset quality trends for some of these consumer-oriented NBFCs can continue?
See, again now, you have to differentiate between one unsecured lender and another unsecured lender. I think that, while valuations are very expensive now, and I can't argue that it's a cheap stock anymore. But having said that, I think that I wouldn't worry on their credit underwriting standards. It was because their credit underwriting standards were so strong. That's the reason why they are where they are today. That is why the market is willing to give them a high price to book. If they had a high gross NPA, like many NBFCs, if you look at, Mahindra & Mahindra has almost reached double digit on 8-9% gross NPA. Many public sector banks have been there. Several specialized NBFCs have also got high gross NPA. They've never gone there. I think that is one. So I think their systems, processes, their credit underwriting standards are a class apart.
Right.
Secondly, we have to also understand that what is the absolute size of the balance sheet, right? No longer are they, as they were 5 years ago, just a 1 or 2 revenue streams. They have several revenue streams. So they have also diversified their book substantially. Secondly, if you look at study their business model, they don't give unsecured loans to anybody or everybody.
Right.
It's mostly a cross-sell to an existing customer. So they understand that customer, they have his or her credit history, and only when they are comfortable are they willing to give an unsecured loan to them. And the third is that the absolute size is still very small, right? Just to give you an example, HDFC Bank's balance sheet size is 8.5-9 lakh crores. This year, the asset side of Bajaj Finance is going to be 65,000 to 70,000 crores. It's less than 1/10 of somebody who has done extreme. Now I know it's not a direct comparison, but I'm saying that you're still a sub 1 lakh crore balance sheet size. So there is enough room to grow, and there can be several Bajaj Finances that can come in. But I think that the whole idea, it's not about secured lending versus unsecured lending. It's about what your credit underwriting standards and processes are. And you could still make money in an unsecured book, provided you run that business very carefully. So on that front, I continue to be very confident about Bajaj Finance. But as I said, valuations are a different issue. One could argue that it's now very richly valued.
So a handful of stocks have actually led this nifty rally that we have seen. So which do you think are likely to be the companies or businesses which could really be the leaders of tomorrow? Which are the next big Bajaj Finances, or which are the areas that they could come from?
See, I think everything will grow eventually, right? But I think the recent rally in the Nifty or the Sensex is being driven by sectors where there is gross under ownership, right? So for example, I don't think people own as much of oil and gas or Reliance as you would own, let us say, an HDFC Bank, for example.
Right.
People don't own so many metals, right? Because it's a very cyclical industry. And this does happen in markets, that there may be parts of the markets that you don't own which go up, and that creates a short-term pain for investors like us who don't invest in cyclical businesses. What will lead the next cycle? I think my sense is that it'll continue. I mean, obviously financials will lead because they are a great proxy for growth, right? So whether you're giving a housing mortgage or you're giving a consumer loan or you're giving an unsecured loan or you're, the only part of the market that's not yet growing is corporate credit, which may take some time to grow. So I think financials will continue to lead even the next round. I also believe that the consumer business or the FMCG sector could also be one of the potential sectors to lead because they will be one of the big beneficiaries of GST because they are very distribution intensive, logistics is a big part of the cost, there will be some savings that will come through. And if we believe that with 2 good monsoons and over the next 12-18 months the government is likely to pump money into the economy, especially at the bottom of the pyramid, that's likely to drive consumption both in rural and urban areas, right? So I think FMCG will also do well. Similarly, autos should do well. I think cement will do well, because there will be infrastructure spending on one side and then the housing growth on the other side. So I think these are some of the sectors that will lead. I think PSU banks and possibly capital goods. I think those will still take a little more time before they can join the party. So those are typically the late cycle movers. PSU banks primarily because of the gross NPA issues. Probably something like an SBI could be an exception to the case because, I think there they have raised capital and, they are in a far better position. But I'm just talking generally speaking, So I think probably the public sector banks and the capital goods and the large infra companies, because of their base, could be a little bit of a laggards and then might join the party later on as the economy picks up over the next few quarters and years.
Right. So we are waiting for a lot of these sectors in the earnings to pick up eventually. But for now, I'm sure a lot of these long-term investors are waiting and hoping that this current correction is a short-lived one and a lot of these markets move on and resume. With that, Hiren, we'd like to thank you. It was a pleasure speaking with you once again.
Equally here, pleasure.
And well, as for you guys, we'll see you once again next week on another edition of Thank God It's Friday. Till then, it's goodbye.